Yes, we can start now.
Okay. Okay. So welcome everyone for our session on central bank digital currency. Today we have the honor to have with us Professor Darrel Duffie and João Manoel as the speakers, and Vínicius Carrasco as invited to handling the questions and during our session. So first of all, Professor Darrel Duffie, thank you very much for taking the time to talk with us today. It's a really pleasure. Always bring new ideas, new topics. So welcome to our session. And also thank you, João. João, I know you are on vacation, so thank you very much again for taking the time to be with us. So our idea is to have, as I said, 30 minutes presentation by Professor Duffie, and then we open to João to talk about the initiatives the Central Bank of Brazil is setting forth regarding central bank digital currency. I think the moment is perfect for that because we have heard from the news that the central bank is initiating this discussion with the industry, with the other market participants. And so I think will be a great opportunity to listen from both of you about these new and exciting topics. So thank you very much, Professor Darrel Duffie. The floor is yours.
Alan, thanks so much. It's a wonderful opportunity to speak again at the Brazilian Finance meeting. It's been a while since I've done that. And today, unfortunately, I have to do it from my living room in Palo Alto because of travel restrictions. But I hope we have a good discussion anyway. I'm looking forward to João's discussion. I'm going to lead off, as you said, and I want to talk about the topic from a general viewpoint, but also specifically from the situation in China, because China is the first large country to introduce a central bank digital currency for real. I know Brazil has it in development, Sweden is developing it, Canada is developing it, my home country. The European Central Bank announced this week that it's putting a development project in place. There are only a few other countries like Brazil that are at the point of development, but China is going to be first. Probably it will release its central bank digital currency around the time of the Beijing Olympics in early next year. And there's already quite a bit of information available, both about why China is doing this and also what it's going to look like. So I think this is a good opportunity for us to sharpen our intuition for why central banks want to do this. I'm going to share some slides, so let me do that now. By the way, the Federal Reserve is also considering a central bank digital currency and will release a white paper on that in the next few weeks, according to reports. But it's not clear yet whether the United States will introduce a central bank digital currency. I testified to the Senate Banking Committee on that last month. And if anyone's interested in my testimony about the costs and benefits for the United States, I'd be happy to send you a copy of that. But again, today, given the amount of detail that's available, let's focus on China. It's also a good focus for me because I'm co-directing a big policy group on China's central bank digital currency with Dr. Elizabeth Economy, who's a China expert in political economy and foreign policy. We have 25 leading experts in computer science, including Dr. Neha Narula, who's leading the US research from the side of MIT on digital currency for the United States, and two leading computer scientists at Stanford, Dan Bonet and David Mazieres. We also have former members of the National Security Council, former undersecretaries of the Treasury, former leading central banker Raghu Rajan, one of the leading economists in the world on digital payments. That's Rob Townsend at MIT. And the list goes on and on. We have a huge amount of expertise that we're bringing to bear specifically on this issue of why China is introducing a central bank digital currency and what are the impacts. So let me just dive into this. And I'm going to start assuming that while most of the audience is familiar with CBDC, not everybody may be. So I'm going to jump into this slow and easy with the prototypical payment situation in which Alice is at the bakery and she needs to pay Bob the baker for her pastries. And it's going to be 80 renminbi, says Bob, and Alice needs to come up with the money. And now the question is how she is going to pay Bob. By the way, in all the payments technical literature, for some reason, it's always Alice and Bob. So I'm going to reproduce that today. So the typical way for that to happen in Brazil, in the United States, and around the world, almost 99% of payments are done via the bank-railed payment system. So by one means or another, Alice sends a message to her bank. Could be on her smartphone. It could be with a credit card tap at the point of sale terminal. It could even be a paper check in the US, which is still popular here. And then Alice's bank will send the 80 renminbi by debiting Alice's account at her bank, sending it through the bank payment rails, and it'll end up in Bob's account. And Bob will get a message saying it's okay to give Alice the pastries and she can leave the shop and go on her way for dinner. Now, sometimes Bob, especially in the United States, but around the world, sometimes Bob won't get the money for a day or two or even more. Instant payment systems are not the norm, although some countries like Mexico, Singapore, and certain other countries have fast payment systems. You can tell me about Brazil later. But in any case, Bob is also going to have to pay a big fee. If Alice pays with a credit card, it's a very large fee. It's around 2.3 or 2.4% in the United States. So this is expensive, it's slow, and it's complicated. There's a lot of spaghetti, let's call it, in the payment system where when Alice taps her phone, it goes to a point of sale reader, then it's cryptographically sent to a merchant processor. From there, a cryptogram token is sent to the credit card company, which then sends an encrypted payment account number to Alice's bank, which says, okay, Alice is good for the money. They send another encrypted payment account number that goes back through the spaghetti, and eventually Bob gets paid. It's very expensive, and there are a lot of opportunities for what economists call rent taking, which means profit taking along the way. It's not a very effective system, and the incentives to fix this system are not so good because when we think about this, let's go back to Alice and Bob. Alice loves to use her credit card. She thinks she's not paying any fees because it's all buried in the price. She gets rewards from United Airlines or money back on her card. As far as she's concerned, it's working fine, but Bob is not doing so well. This is what Jean Tirole and Jean-Charles Rocher called a two-sided market in their 2003 paper, meaning that the payment service providers can bind Alice and Bob into the payment system that they like because of the network externalities of everybody wanting to use the system that everybody else is using. And they do that by giving the incentive to Alice to use the system, by giving her a low-cost, good experience, and then by extracting rents from Bob. And that works. And it makes it also hard for entry because who's going to start a new payment system when Bob is already doing Visa and MasterCard? This extends also into wholesale payments. So the current bank rail payment system, which has been with us for several hundred years, even before electronic payments, is extremely robust. And in principle, it can do everything very well. But the incentives for the banks to improve the efficiency of the payment system is not that good, because if this is Alice here, and this is Alice's bank likes to keep all of its customers close and doesn't really want to make the system very open and interoperable with other payment service providers. These are called walled garden incentives. But in principle, as I said, the technology would work fine if it were updated and kept bank railed. But that's not the way the world is going. 80% of the world's central banks are exploring a central bank digital currency because of the inefficiencies that I described. And of those 80%, I mentioned a few of them that are currently doing development or pilot testing, including Brazil. I'm very curious to learn the situation in Brazil. I know that Banco do Brasil has been charged by the central bank with doing the technology, and I'm very anxious to find out how it's going to work. So if anybody has any clues on that, let me know, please. Here's the new world in China after the central bank introduces its CBDC next year. The central bank is the People's Bank of China, which will give accounts to everybody. So Alice will have an account at the central bank, Bob will have an account at the central bank, and Alice's message through her payment service provider will eventually be sent to the central bank to deduct 80 renminbi directly from Alice's account and into Bob's account with very little fuss or muss. It's not expensive. It's going to be a low cost, high speed, convenient for everybody to use, and cheaper and faster for Bob to get his money. So that's all to the good. There are some downsides though. For example, now the People's Bank of China has all the data, and there's been a lot of controversy about whether it's a good idea to pool all of the payment data in one place. The People's Bank of China is using a system of what they call controllable anonymity, which means Alice's and Bob's anonymity is protected up to a certain point. Of course, in any country, China or otherwise, the authorities need to be in a position to check for the legality of payments. We don't want anti-money, we don't want money laundering, we don't want terrorism financing, we don't want all kinds of avoidance schemes. So payment authorities need to have some data. The question is, how are those data going to be protected? Where are they going to be pooled? Are they going to be pooled at the level of the payment service provider or at the level of the central bank? In China, it's going to be both. Alice's payment service provider will know all of her payment information, and the central bank will have all of the payment details itself. For small amounts, for small account holders, if Alice only wants to do a small amount, she can probably get an account with relatively little information, just a phone number and a registered phone number would be enough. But for large amounts, of course, they need much more information. Some have suggested, by the way, that China prefers this payment system because it wants to have a tighter grip on information in Chinese society for reasons related to its authoritarian government. I'm not an expert in that. I'm not going to talk about that very much today. So I think everybody maybe has the right idea here of how this is going to work. And now let me explain a little bit more about this is a public-private partnership. It's called a two-tiered system in which the payment service providers are not the central bank, they're providing other services. And the payment service providers currently are banks. These are the leading 4 banks in China. Currently, this list is getting longer and longer. There's now 6 or 7 banks. They're being added all the time, smaller banks, or at least medium size. The telephone companies need to be providing services for the payment apps that go onto your mobile phone, and also for the communications of the payments. And then of course, some fintech service providers are providing the software for payments, and they themselves can be payment service providers because they also have banks. So it's a very rich payment ecosystem. It's not as simple as simply Alice and Bob dealing only with the central bank. There's a lot of other market participants involved. And this is most likely, in my view, the model that's going to be used around the world. I think most countries will opt for a system in which Alice and Bob are not going to go down to the central bank and knock on the door and ask someone in the central bank for an account and to get their apps. They're probably going to go through a private firm. In some of these cases in China, some of these firms are state-owned and state-controlled. One of the key objectives of central banks around the world when they're discussing whether to do a central bank digital currency is financial inclusion. What they're hoping is that people that don't already have a bank account and are having difficulty accessing the financial system can access it through CBDC technology. And you can see there's quite a distinction between high-income economies and developing economies in terms of this is the average that I computed across the World Bank's Global Findex database in terms of what fraction have access to banking, and then of the fraction that have access to banking, how many are making digital payments as opposed to just having banking services. And China actually is already quite high on this score. And one of the reasons is that Alipay and Tencent are already offering 800 million or more Chinese consumers very efficient digital payment services on their mobile phones. And that might lead you to ask, well, why does China need a CBDC? And why is it first? You would expect a country with less fintech development than China to be the first out. But China has other motives that I'm going to discuss in just a few minutes. India is a very interesting case. This digital component is changing very rapidly because India has introduced UPI and Aadhaar, which are amazing fintech payment services provided through the government based on mobile phone access through the banking system, not through central bank digital currency. In Kenya, some may ask, well, why does Kenya, which is more of an emerging market economy, have such highly developed digital payment services? And the reason is that an entrepreneur in Kenya developed a mobile phone-based payment service where you pay with telecom units that, the same units that you use to pay your phone bill. You can pay those to a friend, or Alice can pay Bob right off your mobile phone. And that turned out to be extremely popular. That was called M-Pesa. Vietnam is a really interesting case. Vietnam is mainly a paper cash payment system, and it's ripe for innovation. So if I were as young as Alan and João, I would head to Vietnam, start up a payment fintech firm, and shoot this number way up and profit as an entrepreneur, which I expect to happen, by the way. Somebody will do that. So motivation of central bank digital currencies is to increase these numbers, to leapfrog it, in the case of Vietnam, leapfrog all of the complicated, expensive payment system that's been developed in the United States, jump over that directly into a cheap, fast payment system like CBDC. And the answer in every country need not be CBDC. If we have time in the discussion, I'd like to discuss some of my testimony to the Senate Banking Committee about why the US should think very carefully about whether it introduces a CBDC. There are very high costs and benefits that need to be weighed. I do think it should develop a CBDC. The United States would be much better in a position to deploy it later. If it takes 5 years to develop it, it should start developing it now. But the decision about whether to actually deploy it can be deferred until the costs and benefits have been more carefully weighed based on the best available technology, which is not yet clear enough. And the main reason the technology approach is not clear is data privacy. That's the nut that's very difficult to crack. I'm sure computer scientists will get it, but so far there's no obvious design for doing both compliance on the one hand, that is legality of money, anti-money laundering, and on the other hand, protect Alice's and Bob's privacy. Let me give you some motives for why China is actually introducing a CBDC. So let's walk through these one at a time. So first of all, when China started to develop its central bank digital currency, which is called ECNY, the officials in China said, we're very concerned about Bitcoin and Libra. Of course, Libra is now called DM. These American, quote unquote, American things will invade our financial system, and we don't want those invasive cryptocurrencies. Also, they make it difficult for us to enforce capital controls. They make it difficult for us to check the legality of payments, and because they're relatively more anonymous than bank-railed payment systems. So China thought maybe if we have a CBDC, we can block or at least reduce the amount of Bitcoin and DM that's used in China. China, by the way, just recently outlawed, it banned the use of Bitcoin for making payments. Another reason for China is those two dominant payment fintech firms, Alipay and Tenpay, are bothering China's government because they're huge. They have over 95% of digital payments in China are made by those two firms, payment services. That's huge. And China has said it's concerned about the operational risk of letting so much payments be done by small fintech firms. But China has also just recently been hammering fintech or tech firms more generally for their market dominance. And many believe that China's government doesn't want such large dominant technology firms having such a large role to play in China's economy. And one can imagine various reasons for that, some of which have to do with China's Communist Party wanting to be more in the driver's seat. Increasing payment system efficiency through increased speed, interoperability, competition, and programmable money. These are very common objectives of all central banks that are doing research on CBDC. And I'm sure that you've all been thinking in terms of these being some of the main upside, along with financial inclusion, which I just discussed. You may not have considered the fact that if you have a CBDC, then you've got real-time payment information with which to choose your monetary policy. So I'm sure at the Central Bank of Brazil, it won't have escaped the monetary policy team that they're going to, if they have a CBDC, they can watch payments being made in real time, and they'll see prices and velocity of money very, very quickly. They'll also, if by virtue of having a more efficient payment system, when they change the, I forgot, what's the main policy rate in Brazil? Can anybody provide that?
Is it Selic rate?
The Selic, that's right. So when the Central Bank of Brazil changes Selic, they would like to see market rates adjust 1-for-1 or close to that quickly, but that's not what happens. In most places around the world, the central bank moves the target rate up 25 basis points and all the other rates move very slowly behind it, especially if they're deposit rates. And if you have a CBDC, then the monetary policy gets implemented into rates in your economy much more rapidly because the payment system is much more efficient if you design the CBDC well. Many countries are worried that that paper money will grow out of use, and they want to make sure that they have an official substitute. That's the main objective for Sweden, because the Swedes are already very advanced on fintech, and the Riksbank, which is the central bank of Sweden, is very concerned that pretty soon nobody will be using official central bank money, and they don't like that idea. I read a report saying that a very entrepreneurial Swede actually embedded a microchip in his hand so that when he went to the point of sale terminal, he could just wave his hand over the point of sale terminal to buy his goods. They are very advanced there. Another reason, which we saw here in the United States when the COVID pandemic hit, is that the government made enormous distributions, fiscal distributions to the population, and it turned out to be very slow. They paid with paper checks. People didn't get their money, or they got too much money. They got it very late, months later in some cases. It was just not good. If you have a CBDC, you could go pop, everybody gets $1,000. For China, maintaining capital controls, CBDC is easier to do that because if Alice and Bob have their accounts at the central bank, they're less likely to avoid capital controls. And China also wants to internationalize the renminbi, which I'm going to get to in a minute. So those are some of the main policy objectives that, in my view, are motivating China. And most of these are documentable, and they'll be in the report of our policy group when it comes out later this year. Although I'm not speaking for our group, I'm just speaking for myself today. So I'm going to turn to the international side of this, because cross-border payments is one of the worst is one of the worst cased uses of payments, where Alice is over here. She's customer one of her bank, and she wants to send Bob, who's down in Brazil, a birthday gift or a payment for a shipment of oil. And that money has to get to Bob, who's down in Brazil, currently most of the time by correspondent banking, which means Alice's bank searches for another bank that has a corresponding banking relationship with a bank in Brazil. And then that correspondent bank in Brazil finds Bob's bank, there's a currency exchange here, dollars for reais. And Bob gets his money, but less a big fee. And those fees can be on both ends, and they can be egregious, like 10% is not unusual for at least for smallish payments. And even for large payments, it's expensive and it's slow. And there's also credit risk all along these payment rails, because it's not DVP, it's not delivery versus payment. There's a certain amount of hoping that the money is going to get there. This is a breakdown of the cost structure for making cross-border correspondent banking payments. This is from a report by the Bank of Thailand and the Hong Kong Monetary Authority. And I'm not going to go through these in detail, but you can see there's, again, just like in the credit card payment that I showed you at the very beginning, there's a lot of stops along the way where checks have to be done, liquidity needs to be provided, fees are levied, operations are required, compliance costs, foreign exchange fees, bid offer spreads in the foreign exchange market, network management fees, overhead. And as I said, it's a ridiculously expensive and slow situation. And around the world, this is a very important reason to cut through all of this and get something that's simpler. So under the auspices of the Bank for International Settlements, 4 central banks are piloting a multi-CBDC bridge project by which you can cut through a lot of this spaghetti and get those payments from Alice to Bob with fewer hops and less fees and higher speed. Now, this is all in development, but I just want to talk about it very briefly. Notably, the People's Bank of China is part of this project. Whoops. Let's erase that. And I expect the PBOC will extend this payment bridge to include other countries so that cross-border payments can be made more cheaply. Recently, by the way, France and Singapore made an exchange, that was 2 weeks ago, by CBDC, cross-border CBDC. Other pairs of countries will do it. The multi-CBDC bridge can include many different countries. The 4 countries involved are Thailand, United Arab Emirates, People's Bank of China, and the Hong Kong Special Administrative Region. This is a new development. Let me give you a very brief idea at a high level, drawing from the report by the Hong Kong Monetary Authority about roughly how this works. And by the way, the technology for this, it was developed by R3, which is a US fintech firm that provided the technology, which is called Corda. It's a digital ledger technology that uses blockchain. And here's the idea. So Alice's bank might be Bank Thailand, one of the banks shown in Thailand, like Thailand Bank 2. And first they need to get some CBDC in Thailand. It's called WCBDC. The W stands for wholesale. So the wholesale CBDC in Thailand is the medium of payment into, not directly into Hong Kong, but rather into a corridor market. So now with the wholesale CBDC of Thai baht, there is a market inside this corridor in which the wholesale CBDC is converted to tokens which are exchangeable only inside the corridor market. And in that market, different banks offer quotes for converting Thai baht to Hong Kong dollars. Once Bob's bank in Hong Kong or that bank's wholesale provider gets the requisite number of Hong Kong dollars by purchasing them, then they're converted into wholesale CBDC by another digital ledger technology transaction on a blockchain. And now they're in Hong Kong as wholesale CBDC, and then they're converted through the Hong Kong payment system and sent to Bob so that he gets paid for his shipment of containers of furniture or whatever they are. I'm going to stop rather than just continue because there's just so much to share. But let me just summarize, and then we can have a discussion. So in summary, most central banks are thinking about doing this. There are a whole lot of motives for doing it. China has some additional specific motives that are related to the setting of China. The United States is still thinking about it. It hasn't even decided to develop a CBDC. It's still doing research. Brazil is doing a full-on development beginning now. Certain other countries are doing that. My guess is it's, let's say for the US, at least a 5-year project from front to back to get this thing developed. So getting it started now in the US would be a good idea in case you want to use it, because if 3 or 4 years from now it's decided that you want to use it, adding another 5 years to it is not a good idea. And the Federal Reserve Governor, Lael Brainerd, also said in a recent speech that it's easier for the United States to sit at the table, those were her words, of international discussions on standards for CBDCs if the United States already has the technology of CBDC. So I think for a number of reasons, the US should begin development. Brazil's already made that move. And I'd be interested in hearing why those of you, including João, think that Brazil is actually moving ahead with this. Which of the motives that I discussed, or which other motives are pushing Brazil forward on CBDC? That's my take. That's what I'm hoping to learn. That's why I'm here today, Alan and João. So I'm passing the baton back to you and looking forward to a good discussion. I'm going to stop sharing my screen.
Okay, thank you very much, Darrel. It is always a clear view and makes some hard topics easier to understand. So is very good to hear from you. So the idea is now to pass the word to João, and then we can open for the discussion. I think João has some topics he'd like to share with us, and then we open for the discussion, and Vínicius also can bring some topics because he's an expert on payment system here in Brazil. So I think we can have a great discussion about these topics. So João, the floor is yours.
Thanks a lot, Alain. Thanks a lot for the invitation. Really appreciate it. Thanks, Rui, Alain. It's a real pleasure to share this panel with Professor Duffie, an honor. Well, let me start. The central banks, the Banco do Brasil, Banco Central do Brasil's communique on central bank on CBDC has been the third that the Banco Central do Brasil has issued over the last 3 years. This last one has provided a little bit of operational and legal framework details on the CBDC's initiative in Brazil. On a more general tone, I think one could say that CBDC, from the Banco Central do Brasil perspective, is a natural evolution of the recent developments in our payment systems. I think what's pretty noticeable in the Brazilian case is that if you have in mind that one of the goals, not the only goal, as Professor Duffie has said for China's case, and but certainly one of the goals of CBDC is to improve the efficiency and inclusion of retail payments, let's say that. And what I mean by efficiency is, let's say, cheap, fast, available around the clock, 24/7, and also interoperable, and a system that, let's say, faces the challenge of two-sided markets that Professor Duffie has just very adeptly described here. Brazil has already, just as UPI in India and other countries, has a fast payments initiative that has been tremendously successful. That was launched back in November 2020. And we have a clear view that CBDC might be a natural evolution of the fast payments rail that has been already put in place in Brazil. In fact, if one looks at the Brazilian payment system, something close to what one might call a synthetic or a hybrid CBDC, or the essence of it is already in place, by which I mean, we in Brazil have what we call payment accounts, which are not fractional reserve accounts. They are basically full reserve accounts provided by payment service providers. And at the payment service provider, which can be a bank, could be a payment institution, could be a credit union, they're fully backed either by cash reserves at the central bank or by public debt, which basically means that in the end, the liability is a public sector liability, and it's 100% reserve requirement account. So we already had that before fast payments. Now, on top of it, we do have fast payments that work 24/7, round the clock, and it's instantaneous. It's multi-use. It's totally interoperable, and it was done. If one could say, solving the relevant network externalities problems by regulatory mandate and mandating that all payment service providers participate. We didn't quite have a metric of goal of onboarding and penetration, but by any metric has been a tremendous success. We have more than 94 million payees, let's say, registered in the system in the sense that they have an aliases key that identifies them very easily as a payee. It's not that they cannot use as a payer or they cannot receive by the intricate means that bank wires formerly used, but they can be easily identified by their email address or by their cell phone number. It represents almost 60% of wire transfers already in terms of number of transactions. And just to give you a number, we have data that shows that some 657 million people have used the system as payers, and out of those, almost 18 million people had not done a bank wire transfer before in their lives. And this is what we mean by let's say, I'm going to put them in sort of the same bucket, fast payments or efficient retail payments and CBDC. This is what inclusion means. It's like you actually get people that didn't participate to participate, or that's what the data suggests at least. Maybe they did, but by other means. When launching, when issuing the last communiqué on CBDC, the central bank, Banco Central do Brasil, has, in my view, just moved one step forward and by saying, look, we are going to interact with market participants in society into fully implementing a CBDC. It might be a natural development of our fast payment system. we have already established that it will be intermediated in the sense that payment service providers will be custodians of these accounts, and anti-money laundering and anti-terrorism finance will be done by the payment service provider. The central bank won't pay any interest on this digital currency. We view it as a natural extension of the physical real, but with benefits, meaning that we could onboard on the CBDC delivery versus payment. We could onboard smart contracts, and we already established that it will be for retail payments. Our view is that CBDCs might be very important for wholesale payments, but it is also our view that we mostly have the solution, and most of the value at the margin is not at wholesale payments, but at retail payments. We certainly will onboard all online transactions, and we hope to have offline transactions as well, onboarded on both CBDC, but they're also part of the agenda for the Fast Payments Initiative. The legal framework, we haven't decided on the technology, whether it's a distributed ledger or centralized technology. We view this as a process that should be interactive with market participants and decided in co-participation for whatever it is that serve the best purpose of providing best services to retail customers in the end. And one of the goals that Professor Duffie has put forward here that we do have in mind is to improve the efficiency of cross-border payments. When we look at cross-border payments, for historical reasons in Brazil, obviously, because the real is not a fully convertible currency. And what I mean convertible is that, bid-ask spreads are really high, and foreigners cannot have accounts denominated in reais in a seamless way. We view CBDC and our Fast Payments Initiative as two means to improve cross-border efficiency. We already have preliminary discussions, and it was great to see here the four central bank digital currency initiative. We already have preliminary discussions with the authorities in Europe for tips and to advance in a bilateral way. Obviously, given the position of the Brazilian real and the Brazilian economy, the strategy might be different. We might go bilateral with several partners, but the end goal is to improve cross-border payments initiative. And just as a very last comment, Brazil, differently from China, had a credit and debit card rail that was very successful. Despite the challenges of two-sided markets and a verticalized structure where banks also had controlling interests in many of the acquirers, the big acquirers, competition has worked in the credit and debit card rail in Brazil. So we're not leapfrogging like, let's say, China did with social media and payments. But we're building on an infrastructure and a participation by these payment service providers that are already providing a good service, but efficiency and costs and transaction costs can always be improved. And this was our goal with a fast payment system. And this is the goal with the CBDC. And with that, I'm sorry, got a little overexcited here. I'll just pass it back to Alain for discussion.
Okay, thank you very much, João. Here in Brazil, we know is remarkable the set of initiatives the Central Bank of Brazil has put in place, and is definitely always a pleasure to hear what you have in mind. I think now we can start our Q&A session. I think Vínicius has some questions he has prepared. But before I pass the word to Vínicius, I will take the advantage that I am the moderator of this session, and I will ask a question that every time comes to my mind when we talk about CBDC. For sure, the topics about efficiency, financial inclusion are the main goals of CBDC. But on the other hand, you abandon the bank multiplier when you adopt a CBDC. And how much these two these two sides are important, and how to deal with when you abandon the bank multiplier, which is the essence of every bank system in the world.
João, do you want to do that, or shall I?
Please, Professor Duffie, after you.
Okay, let's both do it. Alan, here's how I look at it. If we were talking about a private stablecoin, let's say that's backed by assets that are relatively inelastic, in order to increase the supply of money, you need more assets and you need one-for-one investment, then you would have a potentially inelastic money supply, or part of it. So if that were to be the case, if a stablecoin were to become really big in the payment system, it would be, I think, more challenging to do monetary policy and have an elastic money supply. But with the CBDC, much like the case with paper money, the ability of the central bank to operate through the supply of money, I think, is relatively unaffected. I don't think it's a big challenge in that respect. It is true that bank deposits could be possibly reduced in amount, or the cost of bank deposit funding for banks could rise, because when you increase the efficiency of the payment system, banks have to pay closer to market deposit rates. But again, I don't think that necessarily causes problems with the elasticity of money. It may cause severe problems for bank shareholders.
Mm-hmm.
But I don't think it harmed, my personal view, and this came up in a very interesting discussion this morning in the National Bureau of Economic Research meeting at the Summer Institute, where maybe some of your audience was there. We debated the issue of whether that means a lowering of credit provision by banks. And in my view, if banks are forced to pay more for deposits, it does not necessarily imply that they will make fewer loans, but that's a longer discussion. João, what are your views?
Very similar. So the ability that banks have in doing asset transformation has already been challenged, let's say historically. If you look back 50 years, capital markets have gained importance. I mean, the US leading the way, let's say, junk bonds, commercial papers, money market funds, which are different ways to doing intermediation and also asset transformation that has challenged the position of commercial banks. Let's say, let's just have the US case in mind, because I think it spearheaded the process. CBDCs, and if you look at, for instance, fast payments, it's a payment initiative. It doesn't necessarily have to be linked to a provision of a liquid asset on the liability side. So I don't view this as a major problem, but the Banco Central do Brasil obviously has the goals established by laws to preserve the purchasing power of currency and financial stability, and will implement whatever initiative in general and CBDC in particular having those goals in mind.
Okay. Thank you very much, João and Professor Duffie. So now, Vínicius.
Well, in a way, you made some of my questions, and I guess João touched some of the points I would like to ask. I think that the first one is what is the marginal gain of having a CDBC once you have a fast payment scheme like Brazil has, in which you have 24/7 payments, a cheap way of doing it, an interoperable scheme, and so on and so forth. So is there a real gain in moving to a CDBC once you have a fast payment system that works and it's quite successful? I guess that would be the first obvious question. I guess the second one I have, since João already touched some of those points, is how, and maybe this is for Professor Duffie, how a CDBC would get along with privately issued stable coins. You mentioned that in China, blockchain bitcoins were banned. Is it the way to go, or should we allow for those stable coins privately issued and regulate them as narrow banking or some other type of regulation? So these are my first two questions.
Well, I'll take a shot, and I'm sure João can improve on what I have to say. So first, for a system like you have in Brazil, and there are other countries with a similar system like Mexico, for example, which has a very effective fast payment system that's widely used, or India, which is increasingly the case. I think a CBDC is a much harder case to make for the gain above and beyond, but the case can be made. For example, the technology. One technology is you just take your current fast payment system and you give everybody an account at the central bank rather than at their local bank or their personal bank. And then otherwise it's unchanged. And as João said, it's 100% reserve banking. It's functionally the same for Alice and Bob. Although if there's any technology innovation and whatever, the central bank has to be in charge of making sure it's all up to date, and sometimes central banks are not as fast as entrepreneurs. But if you wanted to go to let's say 20 years ahead and think about smart contracts and security settlement and the Internet of Things, and you want to use blockchain and digital ledger technology, well, the current designs for fast payment systems are not set up to do that. You could do it with a new fast payment system, but not this more kind of low overhead sort that you have right now, which is based on a kind of central database management. China, by the way, is also using not blockchain, it's using a central database management approach to its central bank digital currency. But any central bank thinking about doing that has that's a key fork in the road. Does it want to use basically a fast payment system based approach? Or does it want to use a blockchain digital ledger technology approach? And the latter has some advantages if you go to the next generation. What are your views, João?
They're very similar, Professor Duffie. I think the marginal gain at the end is just to have the option of building and embedding new technologies in a different platform, if that is the case. What I mean is to have smart contracts, programmable money, true DVP. We might want to do it constructing over the fast payment platform, or we might want to do it through a different technology. I think the real value is to leave this option open. Of course, given that we have round the clock instantaneous settlement, very low cost transactions in Brazil, it does reduce the value at the margin, but it does not mean that there isn't any value there. That's why the central bank has issued this communiqué outlaying the goals and the general framework for CBDC.
But it won't necessarily go ahead, right? I mean, first the Banco do Brasil will develop it, and then they can decide later whether to use it. Is that the idea?
We will launch a series of dialogues with market participants to decide, for instance, on the scope, the sequencing, and the technology for CBDC. And having in mind that we already have this fast payment system for which the central bank only provides the infrastructure, meaning the settlement, the regulatory infrastructure, and an identification database, and a EAESP database. The way to go, if we are going to embed, for instance, DVP and smart contracts into the fast payment initiative, or whether this will be a different technology, this will be decided in co-participation with the market. I think we're taking one step forward and one step backwards, saying, look, we want to provide the best infrastructure for the efficiency of transactions. Whether this is a technology that is centralized at the central bank, or whether this is a distributed ledger and a more decentralized technology, will be decided with market participants. We want to have the options open and hear whatever suits better. And this would be a judgment call that the central bank will have to make in the future, let's say over the next 1 or 2 years, or a little more, but over the near future.
Vinicius, can you clue us into the second part of your question?
Oh yeah, the second part of the question regards privately issued stable coins and how they get along with the CBDC, and if you should ban those stable coins or regulate, do sort of narrow banking type of regulation, and what would be the way to deal with them?
Well, okay, I have an interesting anecdote about that, because in my Senate banking testimony, I didn't talk about Bitcoin or stable coins, but I was asked by various senators, they were saying basically, we're having a terrible time with Bitcoin. Senator Warren complained about the amount of energy use. She said for one Bitcoin transaction, you use as much energy as the electricity provided to 50 homes in 1 month, which is remarkable. I don't know if that's true. She also said, and other senators said, they're very disappointed about the use of Bitcoin to do ransom cyber attacks, ransom-based cyber attacks, like the Colonial Pipeline attack, in which the ransom was paid with Bitcoin. And they asked, well, how do we stop Bitcoin? And when I described what might be done, I got 700 and some nasty tweets the next day, and a lot of nasty emails, and I won't repeat what some of them said, because it would offend the ears of everybody here, I'm sure. But basically, Bitcoin is extremely popular among a subset of the population, and they break into 2 different large groups. One is the group that thinks they're going to make a lot of money by investing in Bitcoin, and then the other group that said to me in my emails, Professor Duffie, you have no idea. You don't get the point. The point is, we don't want government. We want to get rid of government. We want to be free. So when you're facing that kind of situation, if enough people want to be free of government, then maybe Bitcoin or something like it is a good idea. Personally, in a market like, or in a country like Brazil or the United States, my view would be that we would be much better off without Bitcoin for purposes, at least, of making payments, because they're very expensive to make, they're hard on the environment, and they make it easier to make illegal payments, even though that's a small fraction of Bitcoin payments. And it would be better if we had either a better stablecoin, like Diem is probably going to be quite compliant and stable in price and extremely compliant with AML and CFT. That would be fine. And similar for the experience of Bob and Alice, probably similar, maybe not quite as good if it's not as universally used and accepted. There's going to be not room for 2 or 3 major stablecoins. There's a CBDC and maybe on the fringe 1 or 2 smaller ones, but you can't have likely the network effects. The network benefits won't support multiple large-scale stablecoins and CBDCs. So let's see what happens. But my view is you should allow entrepreneurs to go ahead with compliant stablecoins, see what they can do, see how they can improve the economy. And then as DM has said itself, they can stand aside if the United States develops a CBDC, they can stand aside and let the CBDC be prime. That's what the DM Foundation people have said.
Right, great.
If I can chip in here, I think it's, I just want to make clear the position of Banco Central do Brasil. We will foster any secure means of payment that embeds legal transaction and guarantees legal transactions. Obviously, I won't go into the libertarian discussion, but we have a duty and a mandate to provide payment services or infrastructures, or to foster payment services, not the central bank providing, but the market, that are efficient, low cost, and secure, and compliant with the Brazilian legislation and all the international agreements that Brazil signs it. We view cryptocurrencies as not a particularly efficient means of payment. It might be an investment vehicle. It could be fine. In essence, you could view any ETF or any fund that invests in Google if transaction costs are, or Alphabet or Facebook, if transaction and brokerage costs are low enough, you could, buy and sell it and use the proceeds to do transactions. But it's not particularly, we don't view this as particularly efficient, as particularly interoperable. And it is crucial that retail payments and wholesale payments comply with the legislation on anti-money laundering and terrorism financing.
Good. I guess we have 2 questions here. One, Marcio Garcia is asking, what's the role of the technology or the infrastructure or the rails of the CDBC to deal with the privacy issues that you both raised? And I would like to add on that and ask, what are the gains of trade? I guess you mentioned somehow the gains of trade that such technology infrastructure might bring. So as a registry device, as a settlement device. So I remember in the beginning of the year, Professor Duffie was commenting on the GameStop, affair, and mentioned that one thing that could be redesigned, if we were to redesign from zero, was a D+2 settlement for stocks. And this leads to some risks and capital, and these are unnecessary types of risks and requirements of capital in a world with technology. So I would like to add on Marcio's question to ask about how this registry settlement technology that might come with the CDBC might bring gains of trade. And I guess the second question, let me put both, asks on the implications. Pedro is asking, what's the implication for competition between fintechs and banks of a CDBC? So I guess we already mentioned the possibility of, cost of funds raising for banks. That is not necessarily bad, right? Because you might think that they have some subsidies on deposit taken. But is there any other type of implication of CDBC on competition between these 2 types of players?
João, I've been going first all the time. You want to go first?
Yes. I mean, I think that decisions on technology and privacy, these are the main questions that we are going to face over the next years when implementing CBDC. If one thinks about it, the credit and debit card rails, and in fact, all the current digital payment rails, they are somewhat much more traceable than cash, right? So, and we as a society, I'm speaking of Brazil in particular now, but we are certainly making decisions on that. We did pass legislation that is our privacy law, similar to the General Data Protection Directive of the European Union. We have bank privacy laws, and we have been dealing with this issue continuously. Evidently, CBDC puts this on a spotlight and brings forward the issues of data privacy, but they have been dealt with, and this trade-off between being easy to use, if there is a trade-off, and privacy. In terms of competition, our goal at this Banco Central do Brasil has always to put forward, like the Fast Payment Initiative, an interoperable platform that is that provides as much as we can symmetric access to all players and all payment service providers, and this has to be the goal. Going, I think, to the first part of your question, Vínicius, one additional advantage that a CBDC might have, and a distributed ledger and a more decentralized technology choice, is providing market participants with the correct incentives to innovate. But if you design centralized platforms like the Fast Payment Initiative in Brazil that is interoperable and all market participants can use it and innovate on top of it, I think you might achieve the same goal. But as I said, I think it's just a matter of leaving the option open.
Yeah, let me take a shot at the potential for smarter settlement. There's an old saying in finance, and this is a Brazilian finance meeting, and the saying goes back long before electronic payments, that nothing good happens between the time of a trade and the time of its settlement. So taking that as a principle, speeding up settlement is good. The problem is if you don't have a smart settlement system, it's not easy to arrange. With the advent of digital ledger technologies, you can basically label the money in advance, basically tokenize it, saying this money is for Vínicius when he sends me my securities. And I print that on the money electronically, and nothing can change that. And so the money is good for you, Vínicius, and you're going to do the same thing with your Brazilian government bonds. And we can make an exchange very, very quickly without going through a whole lot of clearing and title transfers and custody banks and all little bits and pieces snipping away at the time that it takes to do this. So that's a really good thing. I'm doing some new research that says it's not necessarily all good in the following sense. Suppose that it takes you a while to arrange the funding. And so we do the smart settlement, but we do it, let's say, after a couple of days. In the meantime, maybe I can find a way to use the securities because they're printed. They're going to belong to you, Vínicius, 2 days from now. And it's going to be smart settlement. We don't have to worry about all the counterparty risks and the clearing and all the messy stuff. But in the meantime, for the next 2 days, the market for my securities is pretty limited because it says they're going to be owned by you in 2 days, no matter what happens. So the fungibility of the money and the Brazilian government bonds goes down. And what I'm doing in my research is I'm trying to figure out the cost benefit on this. And it can get kind of complicated because maybe in the intervening 2 days, I can you can put out your bonds on a repo with smart settlement that dedicates the bonds to return to you and then come back to me in 2 days. So there's a lot, it's a very interesting problem, both in terms of modeling and practice. And there are companies like Digital Asset Holdings, with whom I've worked, and R3, which I talked about today, that are working on this right now. It's going to be the brave new world of financial technology is coming, and it's going to have tentacles going into all of finance. It's going to be when you sell your house, there won't be necessarily 5 trips with 100 documents to sign. You'll tokenize your house, the deed to your house, and the money will be tokenized, and it'll all happen much easier. You just have to make sure that we know who you are and make sure we get that right. So yeah, it's going to be a big, big change. And having a central bank digital currency that feeds well into that from the core foundation is very, very helpful. Now, it doesn't necessarily mean that needs to be done now. It could be done in the next generation. You could use a fast payment system in the meantime. But I think it is a big advantage. On the issue of competition, I do think it's going to be, there will be banks that will make the leap across to the new world, and there will be banks that will be left behind. Some banks are basically earning a lot of rents on their current approaches to credit and payments, and they're reluctant to cannibalize those profitable franchises and become interoperable and adopt technology that gives them much lower profit margins. And they would have to spend money to get there because they have to introduce the technology. Some banks will just simply not do that, and especially small banks. So, you know, if I were to, I don't speculate this way, but if I were to speculate on banks, I would speculate on the big banks with the giant technology budgets that are forward-leaning, or the neobanks that don't have any legacy franchises to cannibalize. But I would not bet on the legacy smaller banks because it's going to be tough on them, I think. Now, on the other hand, politically, small banks are always very popular in legislatures, so maybe that'll be worked out some other way. But I do think the issue of competition, banks are going to get destacked. Their payment franchises may get taken away from them or become unprofitable. Their deposit franchises may get taken away or become unprofitable. Settlement will be completely different. They'll still be lending, but maybe now that they don't have exclusive access to the payment system and the central bank is providing accounts to payment service providers that are fintech firms, maybe banks won't be using as much short-term funding. Maybe they'll have to go out into long-term markets. That's not so bad. Maturity transformation is not as great as some people think it is, in my view. And,
is it needed? So that's the question. The next question I would do we need to transform maturity, or we can do, you know, lending with equity or lending with long-term debt? What's your view on that?
Well, there's some synergies associated with maturity transformation, but I don't think it's as great as banks might like it to be, because banks are getting a fantastic deal now by taking deposits at below market rates. If the new technologies that João and I are talking about force banks to pay up for deposits, they may term out their borrowing so that they don't need to worry about maturity transformation as much. We'll see. I mean, if you think about large corporations that are not doing maturity transformation, they could fund themselves short, but they don't. They fund themselves long. So maybe we'll see a move in that direction. I don't know. It's really hard to foresee. But I don't think banks are going to, in general, banks are not going to look a lot like they do today. And they already look a lot different today than they did 25 years ago.
Right.
I'd like to ask another question, or make a comment and hear your thoughts on that. I think CBDC is definitely an alternative for countries which don't have instantaneous payment, or they are not incorporating or the financial inclusion in a high level. So the CBDC is one way of touching those points. But when I see a country like Brazil, which has used to be the state of the art in terms of payment, the payment system in Brazil was one of the first wire transfer for retail, and now the instantaneous payment is evolution on that. So in terms of facilitating transaction, we don't need CBDC in Brazil. But where I see is important CBDC, for instance, is for cross-border transactions. So in Brazil, we have a high spread if you want to pay from Brazil to United States, wire transfer, and maybe using the example in Thailand, or the motivation is the Ripple system, where you have domestic players and you have a corridor where someone want to buy that Ripple currency and transform your local currency in Ripple and then transform in US dollars, for instance. So am I wrong, or does it make sense?
Can I add, actually, there was a question on YouTube here, so maybe I'll cite one that is also about convertibility. So I guess the case of Brazil, how this changes, and maybe in China as well. So I guess related question.
João, do you want to go first?
Yeah. In designing the CBDC, I think we have to be wise in badging interoperability, both within borders and cross-border. In the case of Brazil, it's certainly true that a lot of gain can be made in improving the efficiency and the transaction costs on cross-border payments. Truth is, we still, unfortunately, have a very backward exchange legislation. It goes back, some of the laws still in place, they go back 90 years, and not in the good sense that they're stable, in the sense that they were written for a system of a multiple exchange rate, where the state allocated scarce hard currency to different players. You can see that this system is very intricate and doesn't provide, it's not very amicable to enter in competition. CBDC is part of the strategy to improve efficiency. If we design it properly so that it's interoperable with other CBDCs, I think it will be natural to improve the efficiency of cross-border payments.
Yeah, Alan, I do think that the benefit, but proportionately, it's much better in the cross-border area. I mean, the use case is much stronger. But if you think about the volume of payments that are done domestically, even if you can only improve the efficiency of those payments by a small amount, it's going to dominate the cross-border payment effects most likely. So now the question comes, do you maybe do both? You can have a wholesale CBDC that's just for purposes of cross-border payments and it's interbank only. And you could have a general purpose CBDC or a fast payment system to solve the domestic problem. And I think it's still a toss-up in most countries whether it's worth to going from a good fast payment system to a CBDC. It's not clear, and I think it depends a lot on issues like data security and how the data are anonymized, protected from anonymity. America is a special place. I don't know about Brazil, but Americans are extremely reluctant to share their identities and their payment details with a national database. And it's interesting because they have no problem with sharing all their information with Google and with Bank of America and with Visa card. They fill out forms after forms, filling out all their personal information, salary, address, family, everything, and yet putting their ID and basic payment information into a national database. In the United States, a large fraction of the population just insists that that's giving away too much information. And maybe they're right. Maybe if you centralize everything, there's a bigger danger of loss of privacy. I'm not really sure, but I like the two-tiered model that João described, where the payment service providers are looking after the anti-money laundering and countering the financing of terrorism and protecting the data privacy. And the central bank is only providing infrastructure and software. That's not easy to do with a CBDC. It's not as easy to do with a CBDC, a regular CBDC, as it is with a fast payment system. There's some issues involved with compliance, because if one payment service provider thinks that your payment is compliant, but doesn't know what the other payment service provider knows, that's not enough information necessarily to check compliance. If you have a national database of all payment systems, then you can check, but then it becomes more of a centralized data issue. So I think, as I said, it's still a coin toss for me, but developing the technology is definitely worth it and should be begun immediately.
Nice. I have one question, and actually two. So, and they're unrelated actually. So you pointed out, Darrel, that China might be, launching this digital currency to try and, reduce the power of WeChat and Alipay. So what do you think about this need of a government to be the first mover in this game, given that these guys are too big? They have, very, frontier technology, and you have network externality. So being the first is very, important. So this really plays a role. Do you think that governments should speed up because of that? So you mentioned that you have an option value of waiting to see the right technology, but if you wait too much, these guys come in first. What are the risks of that? That one more related to banking is runs. Are we more, we have risks of runs if we have a CDBC, and what's the role of central bank to avoid those more likely runs if it becomes more likely to coordinate on a run with a digital currency?
Yeah, so, well, in China, the government was the second mover. The first movers were WeChat Pay and Alipay. And they got big enough that the China's government decided they were too big. And it's not clear exactly what the concern is. It could be operational. That is, if you're putting all of your eggs in two private sector payment service providers, maybe they're not as reliable as the government might be, and you've got a lot of riding on their quality. Maybe it's antitrust concerns. China has expressed recently, has actually passed new rules saying that you can't have more than a given fraction of the payment market. So there's antitrust concerns, then there's data security issues. China has landed hard on all of its tech firms regarding data security. And it stopped Didi from allowing anyone to update their apps on this is the Uber of China. So the government in China is very, very concerned about the power, the market power of these fintech firms. But the government, remember, going second doesn't mean that you're now stuck and you have to live with that. The government in any country always has the upper hand with respect to the payment system. You can regulate your way into dominance without that much difficulty, in my view, as long as you still have rule of law. And China certainly has a form of rule of law. They can decide exactly what they want the landscape to look like, and they can make it happen. So I'm not worried, and the United States government as well, it can decide later that it wants to regulate into a position of superior power. But now it's getting a bit tricky. We have very big technology firms in the US, firms like Google and Facebook and Amazon, and they're very popular among many people. And if the government were to decide they have too much market power or too much control of data, there's political trade-offs to be made about what to be done. And you notice that the United States government is moving very carefully. It's not just slamming them, but it's also hinting that it may wish to control their degree of market presence and control of data. And that could happen in the payment space as well. But I'm relatively optimistic that that's going to turn out in the payment space, that it's going to turn out okay in that respect. On the runs issue, I think it's overplayed. If you want to allow everybody an account at the central bank, yeah, sure, everybody can move their money out of their bank account and into their central bank deposit account. But you can control that without that much difficulty. We already had run risk. Everyone could have moved their money in 2008 out of one bank and into another bank. And there were relatively few instances in which the government or the Federal Reserve was unable to provide enough liquidity fast enough to stop solvent banks from going under. And I don't think it's going to be an issue with CBDC. If it is an issue, you can limit the sizes of the wallets, and you can limit the amount that's transferred out of the wallet so that it serves perfectly well as a retail payment system up to the level of, let's say, maybe even buying a car. But maybe you don't want to allow wholesale payments to swish out of a giant bank and into CBDC at a moment's notice, if it's in the amounts in the millions. But I don't know. I think that's open to discussion.
Right.
João, what's your view? What's your view on runs, for example?
We also have a constructive view here, very optimistic. I think we've learned international regulation and jurisdictions individually have learned a lot over the last couple of decades, particularly after 2008. And I think the instruments of liquidity assistance and the active role that central banks have been playing in different types of security are enough to stabilize markets when needed. And then, as you said, Professor Duffie, you can, as long as you have digital payments, you can move money around, and you can make decisions on non-convertibility in very stressful situations, and you can limit the size of wallet. I think it's a matter of design. I think we can deal with that.
I agree.
Very well. I think we are getting close to the end of this session. So I'm not sure if Vínicius still have any question, or Professor Duffie or João would like to add something else. We still have time for at least one final question or comment.
Well, I guess I made all of my questions. I don't see any additional one on the chat. So
yeah,
yes, we all. Yeah.
So,
Alan, the only thing I want to say is thank you. I want to thank you and Vínicius and Rui and João for hosting a really great session, and João for the opportunity to offer remarks with you. I hope I get a chance to talk to you in person the next time I go to visit.
Will be very nice.
Or the next time you come here.
It's always great to hear to you, to listen to you.
Yes, it's a great honor. Thanks, Rui. Thanks, Alain. Thanks, Professor Duffie, Vínicius. It's an honor. Professor Duffie, for my generation, is a hero, so it's an honor to.
It was a giant.
yes, yes, definitely.
Well, the honor is all mine. I honestly, I really do want to talk to you, actually. Would you mind getting in touch? Well, I guess I have your email address, so I can get in touch with you. I want to ask you more about your planning at the Central Bank of Brazil.
Most certainly. Most certainly. It was, we tried to get Governor Campos here. Unfortunately, he couldn't make it, but maybe next time.
Yeah, good.
Okay. So again, thank you very much for the time, for the contributions. Definitely, this is a hot topic. We may end this session with more doubts than answer for our questions, but that's the goal of any academic conference. So thank you very much for your time, your contribution.
Thank you
Thanks a
very
lot.
much.
Have a good
Thank
one.
you.